Welcome to the Travelex weekly briefing for April 4th, 2011. The US dollar opened this week within Friday evening's ranges against its G7 counterparts, as a lackluster economic schedule allowed investors to trim their positions and align themselves for harder-hitting economic indicators that are expected to be released later this week. On a broader scale, though, the US dollar is sitting at one of its weakest positions in some time against its major counterparts. Namely, the dollar is at a one-week low against the pound, a 5-month low against the euro, a 3-year low against its arch-rival, the Canadian dollar, and a historic low against the Australian dollar since the Australian dollar was floated in 1983. This dramatic depreciation in the value of the US dollar is largely based on improved yield appeal amongst its counterparts, as in the US Federal Reserve does not see a reason to increase its core interest rates at a time when other counterparts of it, namely other foreign central banks, are signaling rate hikes. The cause? The Fed has repeatedly stated that it will only implement hawkish monetary policy measures when it sees a discernible improvement in US housing activity, employment rates, as well as US inflation rates. And the Fed has repeatedly pointed to weaknesses in these indicators as the culprits to their forbearance on raising rates. Indeed, the employment report that was released on Friday, came in better than expected at 216,000 jobs. But 216,000 jobs is still less than the 250,000 necessary to sustain the US economy. Now, this and other persistent suboptimal levels in US indicators and outperforming economies elsewhere are the primary causes of the drying demand of the dollar. Looking forward, the calendar this week is teeming with high-impact indicators, including tomorrow's or Tuesday's US non-manufacturing ISM indicator, Wednesday's GDP report by the Eurozone, and Friday's Canadian employment report. There are also numerous central bank meetings this week, including Tuesday's Reserve Bank of Australia report, and Thursday's Bank of Japan, Bank of England, and the European Central Bank meeting. Now, among all of these, the European Central Bank appears to currently be taking the spotlight when it comes to investor attention. The ECB has experienced consistently above target inflation rates, and it's highly anticipated to raise interest rates by 25 basis points on Thursday. For this and more information, please feel free to check us out online.